Let's take a closer look at some of the financial statements. We'll start with the balance sheet and look at what's there. Assets, they are economic resources that will lead to economic benefits for the firm in the future. Liabilities are the firm's financial obligations. And equity ownership is assets minus the liabilities. It's the residual bit left over. And it is the capital invested plus retained earnings. Now, balance sheets accounts are classified so that similar items are grouped together. And as I mentioned before, the balance sheet asset portion is organized from, at the top, the most liquid assets. So typically on a balance sheet, the first item you'll see is cash and cash equivalents, to the least liquid. And typically at the least liquid, you'll see the last item on the asset section of the balance sheet will be fixed assets generally. These items are grouped together as property, plant, and equipment, investment property, long-term investments, current assets like cash or invested securities. Intangible assets might be the goodwill from an acquisition or other assets. Now this isn't a complete list, there'll certainly be more, and each company may, depending on how they operate their business, may have other types of things that they'll list in the asset section of their balance sheet. And it's also important to remember that what's on the balance sheet may miss some important assets, if you will, things that will lead to further economic benefits for a firm than just what's listed here. And one of the most common things that we see is intellectual property. Intellectual property may not be listed on the balance sheet. The liabilities and owner's equity sections of the balance sheet are again grouped similarly: common stock, paid-in capital, retained capital, other comprehensive income, current liabilities, long-term debts. And again, the liability section will be organized from most current due, what is due most quickly. So usually the very top of the liability section will have accounts payable, things that are due perhaps in a matter of a few days, short-term debt, things that are due within a year, and long-term debt that might not be due for some years in the future. Turning our attention to the income statement and the categories of items there, you might find expenses being grouped together as cost of goods sold, SG&A, a common term, sales, general and administrative, depreciation and amortization, and interest expense. Revenues could be grouped as sales, gains, and investment income. Let's discuss a little bit the basic accounting equations. Assets equals liabilities plus owner's equity. And if we expand this a bit, we can say assets equals liabilities plus contributed capital, beginning retained earnings, plus revenues minus expenses minus dividends. And so you can essentially see this group right here is actually equal to owner's equity. Now Jayanta is going to expand on a couple of these concepts in the next segment, and then I'll be back to talk a little bit more.
Hello everybody, I'm back to answer the question every self-respecting student of accounting wants answered. Why does the balance sheet balance? Well, one answer which students have given me is that if we follow the rules and we make all the entries, then according to the rules the balance sheet will balance, which of course is correct, but the point is, what is the logic behind the rules which makes the balance sheet balance? Now, accounting has a very large number of rules, and if you try to memorize each of the rules without understanding the logic behind it, it's much more difficult. But there are some logical ideas behind the rules, and if you are familiar with those ideas, it becomes much easier to remember the rules and not make a mistake when you're applying them. So let's start with the first logic, and that is the logic behind the balance sheet. Why does it balance? And here I have two balance sheets which don't balance. So this is the first situation where you see that liabilities and owner's equity is actually more than assets. And the second one, you have liabilities and owner's equity less than assets. So these are two different firms. Both have unbalanced balance sheets. And I will now explain why this cannot happen. So what is the first balance sheet telling me? Well, the first thing that it's telling me is that this firm has assets which add up to a value of 175. And these assets are cash, property, plant and equipment, inventory. So the balance sheet, which has been prepared by accountants, they have assessed the value of property, plant and equipment and inventory to the best of their ability. And they have come up with the numbers 100 for property, plant and equipment, 50 for inventory, and cash, which is 25. There is no doubt cash worth 25 is worth 25, and it adds up to 175. What more does the balance sheet tell me? The balance sheet also tells me that there is debt which the firm needs to pay back, and that is 50. So the firm needs to pay back debt of 50. It has to pay back accounts payable of 50. And owner's equity, the balance sheet states the value of owner's equity equals 135. Now suppose I'm the shareholder, so I own this firm, and the balance sheet is saying that the value which I own is 135. Now actually I'm not the only owner of this firm. The technical term is claimants. There are other claimants on this firm, and these are the people who lent money to the firm. So they are the debt holders, and accounts payable, that is people that provided some goods or services that have not yet been paid. So there are three claimants to the firm: debt holders, accounts payable, and me. I'm the equity holder. Now this balance sheet is saying that the sum of the values of these claims on the firm is 195. Debt has a value of 50, accounts payable a value of 10, and owner's equity a value of 135. Now this is why this can't happen. On one hand, the balance sheet is telling you that the value of assets of the firm is 175, and on the other hand, it is saying that the different people who own the firm, the different claimants, their claims altogether equals 195. So it's like saying that I have $175 in my pocket, and it is owned by 3 different people, and I'm saying that one person owns 50, the other 10, and the third person 135. That can't happen, right? Because the value of claims can't exceed the value of what is being claimed. So I can't have 175 and tell 3 different people that you own this, this and this much, and your claims add up to 195. So liabilities and owner's equity cannot exceed the value of assets. But what about the other situation? Is it possible for liabilities and owner's equity to be less than the value of assets? So here we have the value of assets to be 245, and liabilities and owner's equity adding up to 215. Now this is not possible either, because this particular claimant this particular owner of the firm is the residual claimant, which means that after everybody else has been paid, whatever remains is owned by this person. So it can't be that the value of the firm is 245, the value of liability, that is debt and accounts payable, is 95, so you subtract 95 from 245 and you get 150. That is the residual, right? That is the amount which is left in the firm after the liabilities have been paid, and that residual claim is what is the value to the owner, the shareholders. So this therefore must be 150. Assuming that 80 and 15 were right, then and this 245 was correct, then owner's equity must be 150 and not 120. And if it is 150, then this becomes 245 and the balance sheet balances. So the balance sheet can neither have liabilities and owner's equity larger than assets, nor can it have liabilities and owner's equity less than assets. Now this is a useful check. For example, let's say I have corrected this, and instead of 135 now I say I have 115, and so this is, let's say, 175. So this is a correct balance sheet. Now suppose this firm goes ahead and sells off the property, plant and equipment, and when it goes to the market and sells it, it turns out that the accountant's estimate of the value of the property, plant and equipment, which was 100, is not really correct, but say it sells for 80. So it gets cash of 80. So cash increases to 105. From 25 it increases to 105. Property, plant and equipment is now 0 because it's been sold. And then the value of assets would become 155. That's 105 cash plus 50 inventory. Now suppose the accountants forget to note the impact of this transaction on the income statement. So specifically, they ignore it in the income statement. Then this thing could remain unchanged, this side, it'll be 175. And when you prepare the balance sheet, you look at it and you say, how is this 175 and this 155? There must have been some mistake made in making the entries. And you go back and you realize that when this was sold for 80 and the book value was 100, that's 20 less. This 20 must appear as a loss in the income statement. What you had assumed to be 100 is now turning out to be 80, and that fall by 20 is a loss. Once it is recognized in the income statement, it is going to have an impact on owner's equity through retained earnings, and owner's equity will fall from 115 to 95. So the correct owner's equity due to the loss of 20 would be not 115 but 95, and this would become 155. So the fact that the balance sheet was not balanced gave you a clue that some mistake had been made during the process of preparing the financial statements, and the mistake was that this property, plant and equipment which was sold at a loss, that loss was not taken into account in the income statement, and once you correct that, your balance sheet will again balance. So this is the strength of preparing financial statements in this fashion, because the impact is appearing in two places. It serves as a check that you have remembered to make all the entries correctly. Now the logic that we did for the balance sheet was for a stock statement. That is a statement which provides information about the firm at a point in time. Now we are going to look at the cash flow statement, which is a flow statement. That is, it provides information what happened to the firm over a period of time, not at a point in time, but over a period of time. And here what we have is that over this period of time, there is cash coming into the firm and there is cash going out of the firm. And here the logic is that the firm starts with some cash at the beginning of the period. The cash flow statement takes into account all, that's important, it takes into account all cash transactions and only cash transactions, does not take into account non-cash transactions like depreciation. It takes into account all cash transactions that enter the firm and exit the firm. So what must happen at the end of the period? Well, if you look at all the cash which came in and you subtract all the cash which went out, the difference must equal the increase in cash of the firm. So that's the logic that you'll find in flow statements, like a cash flow statement. Here what you have is you have a certain amount of cash entering the firm and a certain amount exiting the firm, and the change in cash holdings of the firm must equal the amount by which inflows exceed outflows. That will give you the increase in cash held by the firm. So how could this concept serve as a check? Now let's say you're working for a firm and the firm starts with $1,000 cash at the beginning of the period, and you look at the cash flow statement, and the cash flow statement, what you see that the inflows are, let's say 500 and the outflows are 400. So inflows exceed outflows by 100. However, you look at the firm's bank account and you see that at the end of the period, the firm actually has 1200. According to your financial statements, the cash which the firm should have at the end of the period should only be 1000 plus 100, that's 1100. But in reality, the firm has 1200 cash. It means that the cash flow statement has missed a transaction, or maybe put in a transaction which was not there. There's something wrong somewhere. It must be true that inflows must exceed outflows by 200 because the firm started with 1000 cash at the beginning of the period and at the end of the period it has cash of 1200. So inflows must exceed outflows by 200.